Hello, Matthew Bell with InsurancePrescription.com, and today I wanted to talk to you about whether it's possible to over-contribute to your 401k. Caveat, right off the bat, disclaimer, I am not a financial advisor. I cannot give you financial advice. This is not advice about investments or about insurance or about retirement or savings or taxes or any of that. For specific advice, you're going to have to talk to competent and licensed professionals in your area. So your financial advisor, your broker, your tax preparer, whatever the case is. But there are certain issues that, as I think through some of these for myself and for my family, there are certain issues that have been brought to my attention that I felt it was at least a good idea to think through and even to share. One of these has to do with the idea of contributing to the 401k, what that means, and specifically, just so you don't have to wait all the way into the video, the issue here is going to be taxation. That's the issue. And the question is, how much of your retirement portfolio do you really want to put into a bucket that is 100% susceptible to taxation tomorrow, 10 years from now, 15 years from now? And I'll get into that more and explain the concern in just a few minutes. So I'm really going to divide this video basically into three parts. The first is kind of going to be background information just on the 401k a little bit. Number two, we're going to get into what the actual problem is supposed to be. And number three, we'll get into some possible solutions, workarounds, and that kind of thing. This is not a video about market risk. This is a video about tax liability. One of the articles that I consulted brought up kind of a humorous quote from Will Rogers, and the quote essentially is, what is the difference between death and taxes? And the question was answered with the observation that death doesn't get worse every time Congress meets. So the 401k basically started in the 1970s. In 1978, Congress passed its Revenue Act, and that modified the Internal Revenue Services Code. Under Section 401 and subsection K, certain things were spelled out that later became the 401k plan that we know. And this introduced a way to avoid taxation on money that you were going to be compensated for later. So deferred compensation in an employer situation. For this information, I've gone on a number of articles here. First is from CNBC, from an author, Kathleen Elkins. This was published in January of 2017, and it was titled Brief History of the 401k, which changed the way Americans retire. Now, the thing to keep in mind is that when the 401k plans were introduced, so in the 1970s, the highest marginal tax rate was 70%. Now, the U.S. has a graduated tax system so that everybody doesn't pay the same tax. Of course, people who have been paying taxes for many years know this quite well. You have different tax brackets, and the brackets are essentially determined by the amount of income that you have. And there are calculations for this, and there's the difference between a gross income and an adjusted gross income. You factor in deductions and credits, and there's all kinds of complications that can arise. But simply stated, your income, modified, adjusted, is going to determine what your tax bracket is, and the tax bracket determines how much tax you owe. Now, the concept of the 401k is extremely straightforward. It's basically this. While you are in your income earning years, you're going to be in this tax bracket, a higher tax bracket. When you retire, you're going to take a pay cut, and then you're going to be in this tax bracket, a bracket that is lower. So the idea of the 401k is that if you could defer paying taxes on some of your employer compensation while you're in the higher bracket and not pay tax on it until you have decreased your bracket, until you've lowered your bracket in retirement, then you're going to save on some money in terms of taxes, because you're not paying taxes at this rate, you're paying taxes at this rate. That's the concept of the 401k. You're going to defer some of the money that you are owed as an employee working for a company. You're going to defer being compensated for that to a future time, put it into an account that's going to grow tax deferred, and then you're going to pay tax on everything you pull out once you're in retirement. But once you're in retirement, you should be in a lower tax bracket, and therefore you're going to pay taxes at a lower rate. Now, that is straightforward. The joker in the deck, however, is the fact that the actual percentages that are attached to this tax bracket and this tax bracket, the percentages that are attached are not fixed for all time. They are set by the Congress. They're set according to different necessities in terms of revenue for the government, for spending for military and for Medicare and for Social Security and for other government programs. It's tax-based, and the Congress is going to determine what the tax rates are. Tax rates can go up or down. When the 401k plans were introduced, as I said, in the 1970s, the highest bracket was 70%. And for this, I am following very closely a presentation that was given, and this is where the information came to my attention, from David McKnight, who in his presentation, it's called, I think, The Tax Train, he talks about some of these issues. Now, it's important to recognize that even though taxes can go up and down, in the 1970s, when the 401k came out, there were two factors that are relevantly different than they are today. The first factor is that taxes not only were at 70% in terms of the highest bracket, but they literally have been that way since 1936. Taxes had been 70% or higher since 1936, all the way into the 1970s. During the Reagan presidency, tax rates started to decline slightly. By 1981, when salary reductions became a thing, automatic salary reductions that enabled a person to fund a 401k by a salary reduction and never even touching the money, 1981, tax rates finally declined lower than 70%, and the highest tax bracket at that time was around 50%. With tax rates that high, the attraction, of course, was to avoid paying taxes on a portion of the compensation that you would receive as an employee, to kick that tax can down the road, because it was very likely that when you were lowered in terms of your tax bracket, you would be paying a lower tax percent you would if you paid the tax on that money during your working years. There's going to be some continuity here. No matter what time period we look at, people who are in their earning years are going to be paying taxes at a higher rate than people who are in their non-earning years, people who are in their retirement. That's fairly standard. I've run into people who have professed to be making more money in retirement than they did when they were in their working years, but at the same time, for most people, the experience is going to be they're going to be in a lower bracket. The issue, though, is the tax rate at that lower bracket, if it were raised or if it is higher in the future, can very well exceed the tax rate of the bracket that you're in while you're in your working years. And this is the real issue, because if you are deferring paying taxes until a later period of time, that only benefits you if the expectation is you are going to be paying lower taxes. And you might be paying them, number one, because the tax rates are such that when you are in a lower bracket, you're paying a lower rate, or they might just simply have a tax cut in the future, no matter what bracket you're in. But if you think that these scenarios are unlikely, then you might want to spread some of your risk around. Another consideration is this: the highest marginal tax bracket in the United States at any time was 94% in the aftermath of World War II, 94% federal tax bracket. And at that time, the remaining money, that remaining 6%, may have very well gone to whatever state you were in. So once you crossed over into that threshold, and granted, in the aftermath of World War II, that threshold, somewhere around $200,000, would have been worth millions in today's money. Very few people ever would have entered into that bracket, and deductions were handled differently than they are today. However, the Internal Revenue Service has had tax rates that high on the books, and so in the aftermath of World War II, taxes were at 94%. In the 70s, highest tax rates were at 70%, and in the year 2013 to 2017, the highest bracket was essentially 39.6 for married filing jointly, and in 2018 to 2019, that was reduced slightly to around 37%. Of course, in the last few years since the introduction of Obamacare, there has been an extra 3.8% levied on taxpayers to pay for that program. But here's the situation. Over the last several decades, taxes have declined from 94% in the aftermath of World War II to 70% in the 1970s, down to 39, 37% in the last few years. But at the same time, the deficit has gone through the roof. If you look up the U.S. debt clock, and maybe I'll put a screenshot of it as of this writing, when I started to talk about this issue and to think about this issue, the deficit was literally at $22.5 trillion. Now I think it is $23 trillion according to the U.S. debt clock. $23 trillion, which is equivalent to around $68,000, $69,000 for every citizen in the United States of America. In addition to that, there are unfunded obligations or unfunded liabilities, which include things like promises to pay Medicare, promises to pay Social Security benefits, those have exceeded $120 trillion and are hovering right around $126 trillion. So the obligations in this case are unfunded because the government does not have $126 trillion laying around, but they are obligations or liabilities for the government in the sense that they have promised these to seniors, to retirees, and so on. Where are they going to get the money? Well, remember that the 401k, you get a tax deduction when you put money into it. The money grows tax deferred, and then you pay tax on 100% of your money when you go to take a distribution. So the thing about the 401k that's most relevant for this conversation is the fact that money that's in your 401k has never been taxed, and it won't be taxed until you take it out. Now, if taxes are right now at historic lows, and the deficit right now is at a historic high, many commentators, David McKnight included, have worried that this is an inevitable tax hike. We are going to see a tax hike coming inevitably, according to these commentators. There's no way around it. David McKnight, I heard him when he was speaking one time, said that the reason for this, he says, I'll give you a four-letter word that will prove to you that taxes are going up. The four-letter word is simply math. Math is the four-letter word, according to McKnight, and the thing about it is, he says, the U.S. simply cannot sustain its deficit economy given this offset between very low taxes, historically low taxes, and an astronomically high deficit. Now that means that you have to realize with your 401k, you will never get one penny out of that 401k without paying tax. You're not going to be able to spend any of your money in the 401k without paying tax. So you cannot decide between paying tax or not paying tax. The only decision you can make is between paying tax now and paying tax later. But if taxes are now known, we know what they are, they're low, and if taxes later are a mystery, which would you rather do? Pay taxes now or pay taxes later? And that's the fundamental issue. Having said that, I'm writing this, I am speaking here in 2019 in November. Trump's tax cuts are going to extend all the way through the year 2025. That is to say, if he's not impeached and if his tax reforms are not completely unwound and yakety yak, there's lots of questions around it. But in 2025, at the end of the year, on December the 31st, those tax cuts will sunset, regardless of what happens to Trump in the coming days and months. And at that time, the tax laws, the tax rates are going to have to be reset to something. Where will they be set in 2026? We don't know, but many people looking simply at the mathematics of the situation, the economics of the situation, have stated it's almost a sure bet the taxes are going to be higher than they are now, and possibly they could be considerably higher. Now this means a couple of things, just to kind of bear down on the issue here. This means that money you're putting towards your 401k you can think of it as two different things. Number one, it is working, it is saving for your retirement, which is a fantastic thing. You need to be saving for your retirement. Some of the standard numbers that are put forward are that you should be saving around 15% of your income, if you can, for your retirement. Now, many people, when they hear that, think that they should be contributing 15% to their 401k. And indeed, the 401k is one very important vehicle for retirement savings. Should it be the only vehicle? I mean, this is an open question. There are people who say that it should and people who say that it should not. The Economic Policy Institute has written about its concerns about the 401k being used exclusively, and it has stated that it is, quote, a poor substitute for the traditional defined benefit pension plans. So in 2019, according to an article in CNBC, fewer than 13%, around 13% of employers now offer a pension plan compared to about 38% in the 1970s. So when we think of how the 401ks were rolled out in the 1970s, a couple of factors I said were dissimilar. One was the fact that tax rates were very much higher than they are today. And the second is that employers offered more pensions than they do now. And so the 401k was used, when it was rolled out, as a third leg in that three-legged stool, which I've talked about in other videos, the employer pension, government benefits, and private retirement savings. So the 401k was designed to complement other things that you had in place for your retirement. The fact that people rely on it almost exclusively today can be a bit scary. Number one, because the value of the 401k is going to fluctuate with the market. But as I said, This is not a video about market risk. It is a video about tax risk, about your tax liability. And the bottom line issue, the bottom line question that you have to answer, and I can't answer it for you, I can only sort of pose it, is how confident are you in whether your situation is going to be better or worse in the future in terms of taxation? So for instance, if you were sure that your tax rate, or if you believed with reason that your tax rate would be lower in the future, then you would absolutely be trying to take full advantage of the 401k and put as much money into it as possible, because if you feel like the chances are very good that your tax rates will be lower in the future, then it benefits you to postpone paying taxes until the future. On the other hand, if you thought taxes were going to go up in the future, then it would be foolish for you to put money into the 401k from the standpoint of tax liability. Now, I'm going to put an asterisk on that, and I'll come right back to it in just one second. But the third position would be you don't know. You don't know whether taxes are going to go up or down. What do you do in that case? Now, to get to the asterisk, obviously many employers are going to offer what's called a match. Now, when an employer offers a match on your 401k contribution, that means that they, the employer, will put in some money when you put in money. So if it's a dollar for dollar match, if you put in 1% of your pay, they'll put in 1%. If you put in 3%, they'll put in 3%. Often you'll find a match that's not quite dollar for dollar. Maybe it's 50%, maybe it's 75%, whatever it is. Person might put in 8% and get a 6% match. Person might put in 4% and get a 3% match. It depends. You have to check with your plan administrator, your benefits person, your human resource director, and find out for sure how your plan operates and what kind of a match, if any, you get. But when there's a match, it changes the calculus a little bit, because the match is a guaranteed return on your money. So many commentators at this point will say, yes, even though tax liability is great in the 401k, it's free money and you shouldn't leave it on the table. And so if you are sympathetic to that line of thinking, then you might think always take the free money is a good piece of advice. So if you get a match, let's say you get a 4% match on 6% of your salary, then put in the 6%, get the 4% match, and call it a day. But if you're contributing 15% to get a 6% match, then the idea would be you are over contributing to your 401k. You're putting in 9% more than you need to get your match in this case. What else should you do with that money? Well, it depends on your view of taxes. Again, if you think taxes are going to be lower for you in the future, or that your tax situation is going to be better, then by all means, take the extra 9% and throw it into your 401k. If you think taxes are going to be worse for you in the future, however, you would probably be wiser to take that 9% and put it into a vehicle where you're going to be paying tax now, where you're going to be settling up the taxes now. A primary vehicle for that would be the Roth. You don't get a deduction on a Roth, grows tax-free, and if it's been open for 5 years and you're at least 59.5 when you take your distribution, as present rules stand, you won't pay tax on the Roth gains. Another possibility would be, for some people, would be life insurance policy. There is a concept called a life insurance retirement plan. Sometimes it's called a 7702 plan, references to life insurance in the IRS code. But regardless of which type is right for you, the point is simply a point about tax liability. The Roth and the 401k are taxed differently. The Roth, you settle up taxes now. The 401k, you settle up taxes in the future. And if you think, again, future taxes might be worse, it might be worth settling up part of the taxes now. Now, some people will mentally make an adjustment, so if they are, in fact, contributing 15% to their 401k now, and let's suppose, as I just stated, that they get a 4% match when they put in 6%, we're talking then about the extra 9% to get them from 6 to 15. What do you do with the 9%? Well, if you're going to put it into a vehicle that has you paying taxes on it this year and you don't get a tax deduction, some people might just step it down just slightly. So for instance, instead of putting the full 9% into the Roth, and remember there are contribution limits on the Roth, this isn't a video about a Roth, but there are contribution limits that have to be factored in here. But if you step it down, let's say maybe to 8% or 7%, just to take account of the taxes that you're going to have to pay on that money. But that's the point. If you think taxes are going to be worse in the future, it's worth paying the taxes now. If we knew what was going to happen in the future, we could design a perfect plan. We don't know. So this is just for general informational or entertainment purposes only, just to kind of get the wheels turning a little bit, to get you thinking about issues that maybe you haven't thought of before. At some point, the worry is that if taxes go up, you could find yourself having less spendable cash in your 401k, apart from any market downturn, apart from any other kinds of risk. You might have less money to spend in retirement simply because a congressperson has struck out one of the numbers that's assigned to your tax bracket and written a bigger number in its place. A couple of cons: many people will say, well, if you reduce the amount of contribution, or if you are paying tax on your contribution, then there isn't as much money to grow tax deferred. So it's true that in a 401k, if you're not paying tax on money, then there's more money to accumulate at interest. That is true. However, the worry here is that if taxes go up beyond a certain amount, then that extra money that was allowed to accumulate is simply going to be taken as tax in any case. Extra gains that you receive might simply evaporate because you're having to pay them in terms of your tax liability. There are no easy answers here. My purpose in this video is simply to raise some issues, maybe help you think through them a bit. If you found something of interest, something provocative, something that sparked your thinking, whether you agree or disagree, I don't know what to tell you ultimately, but I can simply say that these considerations were ones that were new to me when I heard them, and I thought they were at least important enough to share. If you found something then of use in the video, please like it, please subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I plan on thinking through a little bit of more issues like this in the future, and I look forward to seeing you again in another video. Thank you so much for joining me today.